I think the best place right now to find actual yield or current pay is retail. I don't know if I would have got out of that deal the same way. It was a very challenging deal, and I just caught the momentum of the market. People constantly get enamored with that, even industrial. Well, it's only $40, $30 a foot, but it's archaic, it's obsolete.
I'll send people deals and I'll be like, this is what the seller's asking. It's too much. I know that already. But if you like the deal, then offer where it makes sense for you. The seller's like, no, I'm not interested. But then 6 months later, who are they going to call? They're going to call the people who actually brought an offer.
That's right. It's all about having a dialogue. Just start a dialogue. Just talk to them.
What's going on, everybody? Welcome to another episode of the Commercial Real Estate Blueprint Podcast. I'm super excited for today's guest. We have Jarred Elmar. We've had on the podcast before. We think it was probably about a year ago, but since then he's made a lot of progress. He came out with a book. He's bought a lot more deals. We've also come a good way in our journey, and we love doing travel podcasts. We always take away a whole bunch of ideas and knowledge and get to hang out with people like you. So
I appreciate having me again. 100th episode, yeah?
Yeah, this is the 100th
I love it.
episode.
This is great. It's honor to be part of this. And
Yeah.
the fact that you guys do what you do the same stuff that my office does, and maybe we're at a different scale at the moment, but everything, the people that you're interviewing and all the nuggets that you pick up, we'll see you at the top for sure.
Yeah, appreciate that.
Yeah.
It's amazing. We were fortunate to have like one of the first guests we had. He was like, yeah, focus on the content and the podcast and stuff because it'll just open up so many opportunities for you.
Yeah.
And that's definitely been the case. We've met a lot of awesome people and made a lot of awesome connections. And also, like we were talking about a little bit before, it just builds a lot of trust with people who don't know you. And I know you do a lot of like video content and stuff, which is awesome.
Yeah, absolutely. Listen, open book. I started with a pretty rough upbringing. Didn't really have a lot of structure. Was not destined for college. So the whole idea was, self-development, education, and you didn't have YouTube and all this social media content and all this free information available. You had to buy courses and at the time CDs. It was a lot. I was buying Tony Robbins and a mentor for all of us, Scott Shield, and I bought his first course to learn, how to crack the code of commercial real estate. But in the beginning, it was all residential, which I'm sure a lot of your listeners start with. And I bought a course in 1999, how to buy houses with no money down. And it was a gentleman that really started a lot of real estate investors' careers early on, which was Carlton Sheets. It really essentially was troubled assets that were owned by, absentee landlords or older landlords or somebody that had a life change that just didn't want to take the trash out anymore. And you kind of came in as the white knight, but work out a win-win scenario. And a lot of times that was seller financing. So I got a guy to take a chance on me. I had $1,500 to my name, and I bought one single family home. I kicked out the riffraff. I had a couple buddies of mine come fix up the house, and we increased the rent by about $200-$300 a month, and it was only cash flowing probably about $200 a month free cash flow after everything. But I had proof of concept for myself, and I thought, okay, if I could do this, 100 more times, I got a business here. So it was a lot of dialing for dollars, finding those tenants that were having, those landlords that were having a lot of challenges with their tenants. And then I found another guy to take a chance on me. So now I have these two houses. And around that time, Wachovia, which is now Wells Fargo, was allowing you to tap equity out of these rental properties. So I was able to pull out about $15,000 out of those two homes. And I bought another course to find where the real value for single family homes were. And it turned out it was on the courthouse steps, all the auctions that all the counties have every month. And I worked that course, and I started hitting all the county websites, all the county auctions right on the physical steps of the courthouse. And I started seeing the seasoned guys on the steps on what they're bidding on. So you got to follow them. Then we started getting pretty good at this. And when I say they, I had an uncle of mine. He had no money. I was constantly just tapping equity out of one house after another, and he was helping management. He helped manage. He was boots on the ground. And we got to a point where we became the seasoned guy on the auction steps. And then we had to figure out, okay, how do we get people to stop duplicating us and mirroring what we're bidding on? So there was a lot of creativity, a lot of strategy in that process. And we got up to about 65 houses. And in 2007, before anybody really sensed that GFC was right around the corner, it was early 07, I got an unsolicited offer for 55 of the 65 houses. And I had to take it. And it was the most money I've ever seen at the time. And it really kind of prepared me to take advantage of the foreclosure process, the REOs that started flushing through the system in late 09, 2010, and got into apartments. 156-unit apartment complex was my first deal. That was my first syndication. I had 9 guys that were willing to invest. And that really started the business, and that's really how Geneva Group was born. Originally, we thought we were going to stay residential, but after selling those houses, I started looking for the next mentor and found you guys at the same place, which was Commercial Academy. And it was all about buying a $5 million building with no money down or little to no money of your own money in. And that was, it worked the first time with residential, so why not commercial? And that's really what started it off. So it was constantly being coachable, finding a mentor and, and following and not deviating out of a certain buying box. And now, because these mentors help propel my business, I look forward to doing these type of podcasts and to have these conversations, especially with guys like you that are just at the precipice of your career. Yeah, I mean, I'm sure we could talk a lot of strategy and war stories, but that's kind of the 30,000 foot view of how we started.
That's incredible. Yeah, I mean, I feel like so many people start in residential just like that, and then they go on and they progress to multifamily, and then a lot of people stop right there. They don't go off into office or like actual true commercial, industrial, retail, all that stuff. And that's like mostly what you guys focus on now. So I'm curious, like, tell us a little bit about your company now, because you told us about the journey beforehand, but like, what are you guys doing today?
Well, all this was really like trial by fire. I didn't know how I was going to scale this business. I built the houses. I built up the portfolio of houses, sold the houses, got into apartments. So obviously, once we got into apartments, I figured, okay, that's the direction we're going to go. Just stay with multifamily. It's the evolution, the natural evolution from single family homes. But I didn't realize that all multifamily wasn't built the same. Class C in the hood of major metro cities are not the same as nice, 2000s vintage garden style in the suburbs. But I didn't know that when I was in the throes of it. So after the murder, inside of 30 days of buying that building, the fires and the trucks going through buildings and all the other things that you've heard in the past, I didn't think I can really scale the business without really just tearing my hair out. I felt like there had to be a different path. So once we were successful exiting that deal, I wanted to see what else was out there. And, through the mentorship, through, a coaching platform like we were all part of, I started to get exposed to retail and industrial and office and medical and all the alternatives like mobile home parks and self-storage. And I'm like, all right, well, why would I just stop with one? Let's figure this out. Because I didn't know what was going to be ideal for us. So the next deal we did was a retail deal. Knew nothing about retail. It was a vacant CVS building. We got 3 tenants in that building. We subdivided. And I learned how important synergy between the businesses are inside of retail. And obviously all the fundamentals that go along with retail, like traffic and access and parking ratios and all that stuff. So I got a bachelor's degree in retail just with that one building, and learning the tricks of the trade to basically essentially poach and pillage from the community by pulling tenants from other buildings because we had just a superior location. So it was really grassroots prospecting. It was knocking on doors. Hey, I don't know if your lease is coming up, but I have this location. This is the vacancy right now. These are the 2 tenants moving in. I think you're selling organic canine food. I just put a doggy daycare and a veterinarian in the building. I think they would really complement your business. So those were the hot buttons. We're like, all right, we'll take a look at that. So I learned retail and then got into office. Around just over 10 years ago, we really started focusing on industrial, because when we were raising money to close on the deals, that was hard enough. To put 30% down or 35% down on a property, and then to think, okay, you need closing costs, you need tenant improvement dollars, you need CapEx and all this other stuff outside of what you need for your downstroke. I started thinking about, well, what could we buy that doesn't have a lot of finishes? Or we have to think about how long the units might stay vacant. So we got into industrial, and industrial has less finishes. So it's just a lot more easier to underwrite. And at the time it was important because we didn't have a staff. So I looked for the easiest asset class that would allow us to avoid concentration risk with any one tenant. So we found industrial, and specifically small bay, where it was a lot of tenants within one complex, and your finishes were like painting the floor and maybe replacing the window AC unit, the shakers. So it was a lot easier than a retail building where the tenant's going to need $100,000 to build out the space. So that's really what we stayed focused on over the last 12 years, and here we are still doing it. 2/3 of the portfolio is industrial, but we still focus on retail. And at the end of the day, we're like you guys. We're opportunistic. We're going to look at virtually every product type within commercial. To find the best deal, because we want as many at-bats as we possibly can. It's a volume game, numbers game, and that's it doesn't really change regardless of the size you get to.
And you described exactly why we started with industrial, because we still don't have a ton of money. We still love the simplicity of industrial. It's paint, new HVAC, it's going to cost less than 20 grand. You might put a new roof on it, maybe, if you can even negotiate a seller credit, which is what we're doing right now on a deal that we're under contract on right now. But it's just so simple, and simplicity scales is what we keep telling ourselves. And you've shown that it does that.
You're always taking a flyer on tenants. I mean, that's the reality. If it's not a national credit tenant, even if it is, then you got to worry about, bankruptcies. But when you're really taking a risk on all these different tenants. So at least in the industrial space, if you're taking a risk on a non-credit tenant, automotive or a contractor or tradesman, to have a revolving door where the unit doesn't have to constantly be turned over with new high-end finishes, you actually can make a real good living with a revolving door of tenant base, revolving door of tenants. So that really appealed to me on the small bay stuff, where you don't necessarily have that in retail and other product types.
Yeah, that's true. Our intern was asking us if we had any commonality in our tenants, and it's we have about 10 spaces in our portfolio, and nobody's the same. Everybody does something different. Yeah. So that's kind of wild to think about.
A lot of different people who can go in the space, because it's just
it's
concrete floor, metal walls, or maybe brick walls. But
yeah. How fascinating is all the different industries in one building? That's the thing I love the most. What do you guys do? Really, ammunition engraving, it's all this crazy
just random stuff.
Yeah.
One of our tenants does metal fabrication for railroads and stuff.
Yeah.
So it's just the most wild stuff.
Yeah, off the wall. You just never know what you're going to run into, which is cool and fun.
Yeah. I wanted to talk about what we talked about a second ago, the first go round, which was, Jesse had brought up, where how many deals you've done over the last several years and how you can try to shoot to do one a quarter maybe. But you talked about a guy, Gary, I believe.
Yeah.
If you could repeat what you said, I thought that was really interesting.
Yeah. You look back, and obviously hindsight's 2020. We should have bought virtually every deal we looked at from 2010 to, at least 2016. But we were slow and steady. We were very disciplined because we couldn't afford to get it wrong, and neither can you. Yeah. So it's appealing to have that deal velocity, but you don't want to be a statistic. And there's a lot of guys, especially young guys that haven't seen a crash. They're going to smoke themselves out, because it's just a matter of when the music stops. And a lot of guys are overpaying right now, and they're just not being slow and steady. There's tons of uncertainty, so much uncertainty right now, and there's a lot of abnormalities in the market that are going to start leveling out. But right now, it's very tough to find a deal. So in hindsight, we should have bought double the deals that we bought, but it could also went the other way. So the guy who I really mirrored my capital structure was Gary Rappaport, who's talk about somebody who just gives his time for decades to perfect strangers. He wrote a book. Everybody who's ever been a member of ICSC has looked at that, seen that book. His whole thing was, I'm going to develop a shopping center a year. One shopping center a year. That's it. I'm not going to get shiny object syndrome. I'm going to focus on this. And here it is 30 years later. He's got 30 shopping centers with national credit grocers, and he just never sold. So I started to see that to get to the next level is to create a model where you don't have to sell, to hang on to the assets. I started to find that the longer I held the asset, the more they were cash flowing. And I know it seems kind of obvious, but we learned how to buy a value add deal, force appreciation into it in a short period of time, and then sell it. And in the beginning, you have to do that. You have proof of concept. You got to stockpile your own cash. A lot of reasons why you got to sell within a certain time frame, because that's kind of what you sold your investors if you have investors. But at a certain point, the real generational wealth happens when you hold the assets. And today we have assets that we've held for 12 years, 13 years. By far, those are the best deals that we have. The basis is obviously lower. We've hammered down the debt. Maybe we've refinanced it a couple times. And, it still cash flows, even though we've gotten our money back at least twice. So that's really the goal for our company now, is to try not to have to sell.
Yeah. Yeah. I think the way that you put in your book was, and if you haven't read his book, Built from Nothing, it's a phenomenal book. Graham and I both read it, and I didn't know that much about your story, but not to digress, but it's a really great book. It's on Audible and Amazon, I believe. I appreciate it. Definitely read that. But the way that you put in your book was buying cash flow machines, I believe is the terminology you used, which is cool because that's exactly what got Graham and I into commercial real estate. We wanted to buy cash flow properties. I feel like a lot of people try to do the forced appreciation, yes, but they're trying to focus on appreciation only a lot of times. I think it's cool that that's the way that you see it.
Yeah, you only know what you've been doing, and as a broker, it's all about transactions, right?
Yeah.
And there really is no cash flow. It's just sporadic transactions.
Right.
And when you fix up a house and you flip it, it's a transaction. When you start to think about all the different legs that generate profit and gains on commercial real estate, you start to realize the longer you hold it, the more of a compounding effect it has. I mean, you got an asset that, appreciates while it depreciates. So whatever cash flow you have an ability to offset that cash flow through the actual depreciation of the property, but yet the value of the property is going up. Plus you got all these tenants hammering down your debt each and every month. That's the sexiest thing in the world when you actually have a portfolio and you actually have a lot of leverage. And when I say a lot of leverage, low leverage per asset, but a lot of leverage over the portfolio. And every single month you are hammering down debt. And the more assets you buy and the more tenants you have, you're hammering down more and more debt. And that just drops to your bottom line on your financial statement. So when you look at all that together over years, you see why these guys, these old guys, nobody's worth 40, 50 million in this business. They're hundreds of millions of dollars in commercial real estate, if not billions. Yeah. You're in Boca Raton. I could tell you there is one man who essentially owns at least half of every building, including this one, in the city, in East Boca. And he did it one center at a time. And he saw that Boca was untapped, and he called it right. And
that's amazing.
He's worth billions, and he bought one little center like this at a time.
That's crazy. It makes me think, because like where we're buying right now is like a tertiary market for sure. It's North Carolina, so North Carolina's great, but it's like called the Triad, so it's about an hour from Raleigh and Durham area. And we always talk about like we're buying around like $40 a foot industrial. So it's like it's in my mind, it's like in North Carolina it's growing so much. It's like there's no way this couldn't be if we held it for 5, 6, 7, 8 years, worth substantially more. But
we're trying to do some flips right now. It's something we're kind of doing a little bit differently. Our goal was to add $10,000 of cash flow a month this year, but we think that once we flip these deals, it's going to help us into the next deal kind of thing. Like I think Tyler Caldwell said it as, I'm going to go ahead and take my 5 or so years of cash flow now and then turn that into the next asset and keep flipping into kind of like what you're saying with proving your track record. Yeah. But at the same time, it's helping us build cash flow. Yeah, exactly.
At the beginning of your career, you got to do that. You're buying stuff that you're not going to want to hold. Yeah. Sometimes, again, we're a little bit of a deal junkie too. So we'll buy deals that we're like, all right, we don't want to hold this. Let's go ahead and do what we do, fix it up, and let's sell it to the next person. Yeah. So we still do that. We just have a core set of properties that we really don't want to sell. It's really our legacy assets. But we still, I'm sure you guys are flipping contracts. You're buying this deal. You're JVing on this deal. This business is a grind, and what 100%. What people don't realize is, you don't want to jump out of your job and into this, burn your ships at shore and hope that this works out. But at the same time, you're only going to get so far doing this a couple hours a day. Where the real magic happens is when you're plugging away 10 hours a day looking for the next great deal. Constantly on the phone with the brokers, constantly on the phone with other people that do what you do. The best part about our business is it's not about competition. There's so much more collaboration that happens in this business than competitors. I can't tell you how many times we go head to head on a widely marketed deal that goes through the call for offers process, and we realize there's local guys that we know very well that are going after it. So we're like, why don't we just join forces and do this? Otherwise, we're just going to bid it up against each other. Yeah. So let's do that. So, again, I'm a big proponent in partnerships. I know some people, they're a little skittish with that. They've had bad experiences. But, there's, at the end of the day, you're betting on the person. So you hopefully you have some emotional intelligence and you can determine whether, you just feel good about 100%, this person. Yeah. But, between that and whatever legal paperwork, I wholeheartedly endorse partnerships with the right structure.
Because you're jumping into a new partnership with in mind that you're going to do 10 more deals with that person. It's not
Correct.
Just that one deal.
It's not a one-time thing, right?
Exactly.
You talked about something that I want to ask for myself and also just for the audience. So like you said, you have a core group of properties that you want to hold, and you know very specifically that if you buy a deal, like, hey, we don't want to hold this one, but we do want to hold this one. So like, what should somebody be looking at in a property that makes it something like, I want to hold this property?
There's deals that you're going to buy that you realize when you're going to plateau on really the value. We had a deal in Coral Springs, so west of here. Great little market. It's a little higher blue collar than, Boca's more affluent, but it's a great area, very dense, a lot of rooftops. It's a neighborhood shopping center. That deal unless you were tearing it down to redevelop because there was some rear parcels, there was additional land, we really maximized the value on that center. There really is not a lot, there's not a lot more juice. So it always is that question, and it's become somewhat of a cliche in our business. If you're not selling it, then you're buying it. So at whatever value it is, if you say no to that sale price, then you're buying it at that price. That's a deal where I wouldn't have bought it at what we were able to sell it for. It didn't make sense because we're not a coupon clipper type investor, and neither are you guys. You're not buying something just for the yield. You're buying it for the real pop at the end, or maybe when you refinance, you can tap the money out. So that's a deal where we just knew there was really nothing more we could do except just wait for years and years and years and wait and just clip the coupon at a certain point. And there's some deals that we will do that, but that deal it was a little small. The way we structured it at the time, it wasn't really, we were not aligned any longer with the investors if we held it. So it made sense to just exit and, surpass our projections to our investors as we have done 62 times now. There's another deal we have that is on the market. It's funny, we mentioned a person, Sunny. She offered on the property. That's a deal that I don't love the real estate. It's a great market. It's very densely populated, but it's got an office component, which is always leased up. It's got a retail component, but I don't have the visibility. It's a little bit of an awkward shape. So in the future, I don't think the land is going to be much more valuable. Maybe we'll just continue to get upticks in rent, but that's another one. I just feel like we've maximized the value. It doesn't make sense for us to hold it. We're on to bigger and better deals.
Yeah, that makes sense.
Money like speed, and what I feel like I'm hearing is you kind of got all that you kind of can get out of it. Maybe you're leaving like 10-15% on top of what could potentially be there maybe, but you're just kind of like moving the money to keep the money moving essentially.
Yeah, and listen, I remember a guy, third generation commercial real estate guy out of Chicago. He said it so eloquently. He says, here's the reason why you sell. Sometimes you just need the money.
Yeah.
This is a very capital intensive industry. And remember, if you don't have the dollars to pounce on an opportunity, that's a big opportunity loss. So it's a constant balancing act in our business to have be flush with enough cash, but also to hold assets that are worth holding on to. There's probably one or two assets that I kick on ourselves a little bit that we probably should have held on to it. But then I think about the opportunities we would not have been able to take advantage of if we would have held that particular asset. So it was the right time because the market momentum. Today, we're not selling unless and this is the problem with the market right now. Occupancy is pretty good across the board, across virtually every product type, especially in markets like this, except maybe office is a bit in flux, as we know. There's no reason for a seller to sell when occupancy is good and rent's pretty good, right? There's no distress. There's a little stress. There's a little uncertainty, but there's no distress. So I don't want to sell, nor does anybody else want to sell for the value that it is today. We want to sell for the value it was 3 years ago when rates were 3.5%. So that's the problem right now. And because there hasn't been a lot of transaction volume, there's not a lot of price discovery right now. So what's happening now, and I'm talking to brokers all day, every day, these brokers are slammed with deals right now, listings. The top brokers have more listings than they've ever had in their career, but not many are going to get into the closing table. Everybody's testing the market to determine value. Nobody knows what their properties are worth right now when rates shot up double and doesn't look like they're coming down anytime soon. Yeah. So that we're seeing a lot of opportunities, but there's not a lot of movement on the price.
Interesting.
I do feel like we're kind of seeing that a little bit in our own listings. We're brokers by day, but we're getting to the principal side, and that's something we're definitely going to talk about here in a little bit. But I feel like I kind of see that transaction volume's been down in our market as well. We're doing deals, we're seeing deals get done, but yeah, it's not happening as much. At
least here, where values are somewhat inflated in certain markets.
Yeah.
Nobody's leaning in. Yeah. Nobody's stretching at this stage because there is so much uncertainty, and credit is available, but it's not really that attractive. So I think everybody's just kind of waiting. The difference between today and how it was, during the global financial crisis is there's still a lot of liquidity in the market. There's a lot of funds, right? Especially multifamily, which I think is a huge opportunity toward the end of this year. There's so much money sitting on the sidelines ready to pounce. So I don't see this massive correction in multifamily other than maybe like the 60s, 70s vintage, Class C. Those are flushing through the system because a lot of the syndicators weren't able to, right size their loans when their loans came due. They were floating debt.
Yeah.
It was just a perfect storm of
There's
negativity.
some big people like Brandon Turner, the guy, Bigger Pockets guy. You probably heard of him. Like he just posted something like a couple days ago about this big long thing talking about how his deal went sideways and he lost like $15 million.
It went to zero. The fund went to zero.
Yeah, they lost $15 million on a deal.
Yeah.
And had to sell it. So yeah, I've heard a lot of stories like that with multifamily.
it's hard to pull the reins back on yourself when you're established, you have success, you have a level of success, and that's always a problem. Success. Because it leads smart people to thinking that they actually, or leads people to think that they're actually smart. Yeah. A lot of times it's just the momentum of the market. So there's so many even seasoned guys that floated debt, bought at 3.5 caps, had a very thin margin, but then rents flattened out or went down, expenses went up, and rates doubled. I mean, it's just a perfect storm. Yeah. And you're seeing a lot of that now flush through systems because the banks aren't pretending and extending any longer.
Yeah. So you've done 62 deals, and you mentioned you've had pretty much a perfect track record. You've done better than expected for investors. Like, us listening to that, we've had a decent run buying, 9 buildings in the last couple of years, and feels like we have a lot of success. But that's definitely something I think about. I'm scared of, like, I don't want to do the next deal and it's going to go sideways. So, like, how do you recommend people, avoid that? I know it's like, it's a hard question to answer, but are there things that you do to make sure? Or?
Yeah, and it doesn't change. It didn't change from 10 years ago to now. It's got to be a blaringly obvious profit on the deal. When you underwrite the deal, and we get granular. I mean, we get very detailed, but if it doesn't work on a high level, it's not going to work in going into too much detail. We use Argus, which talks you out of more deals than you do. The probability of leases renewing versus not renewing, and factoring all those dollars in the future if they don't renew. There's just so much that goes into it. And look, you can play with those numbers every which way to convince yourself it's a good deal. On a high level, back of the napkin, you could pretty much determine if there's real value there. And we haven't changed that. Again, in hindsight, if we're just not we're not momentum investors, and if we were momentum investors, we would have done exactly what all the multifamily guys did 3-4 years ago, which is load up on debt, buy deals at 3.5 caps because they're quality assets, and hope for the best. And you see what happened. A lot of these guys are getting wiped out. So it's staying true to a specific buying box that you set for yourself, and your buying box is going to be based upon your cost of capital. And the cost of capital, it's your investors. What are they expecting to get back, to make? What do you have to sell them? What return do you have to sell them for them to keep coming back and invest in your deal? For us, we know exactly what that number is, and we reverse engineer all of our underwriting to back into that number because that's what I know my investors will be interested in. Then from there, we got to figure out how much juice is left for us. If there's not enough juice for us to do the deal, then we need a reduction in the purchase price, or it's simply not the right asset. And that's how we go into every single one of our deals.
That's incredible.
Melted into what works best for you guys, not trying to do anything that's too far out. So you guys run a pref. Some people think of that as like almost a loan back to the investors. What's your thoughts on that? I know you've always run the pref, but I'm curious.
The preferred return just simply puts their dollars in front of ours. Yeah, I guess you can call it a loan, right? It's dollars that you're going to owe to the investors so long as the property can support it at some point in the hold period. Again, a loan, like as a lender, that's your master to serve, right? An equity partner is in for the good and for the bad. So even though you get a preferred return, you're still an equity partner. You're in for the good, you're in for the bad. However, to sweeten it up a bit, your dollars are before ours, and that's why you offer a preferred return. So they get the first set of dollars before you see any money. So that's why I always believe in that. I know people that are doing it with no pref. I think they're doing it with very unsophisticated investors. You absolutely need a preferred return. You need to know that there's a certain amount of money you're going to make before that operator sees the dollar.
Makes sense. Yeah, it keeps people aligned too.
Absolutely,
for sure. Like, what do you try to expect or sell to your investors on, X amount of pref and X amount of equity multiple, or like on the sale or refinance? Or
you're saying what are investors most interested in?
Yeah.
That's a good question. So I don't want to make a blanket statement, but I find that you're more seasoned, sophisticated investors that invest in, private equity deals, funds, different operators. They're looking at equity multiples, but then you have the retail investor, maybe not so savvy in terms of real estate, that they're borrowing from a stock portfolio at a certain interest rate. So current pay is more important than that equity multiple. They just want to make that arbitrage. So I try to put my investors in different categories. I have investors that have self-directed IRAs. They don't necessarily they don't care about the coupon because they don't see it. They don't care about the depreciation. They don't benefit from it. So that's a certain tranche of investors that I know if I have a certain deal that matches that criteria, like a land development deal, that's perfect. And I have other ones that really like yield. They are borrowing from their stock portfolio or borrowing from something, so they have to make that spread. And then I have other guys that they just care about that equity multiple. So I would have those interviews with your investor to find out what their hot button is, so you know exactly when to call them on what specific deal that pops up.
That makes sense. I'm curious. I know you like your stuff is in South Florida and you've done some in Atlanta, but like, is there a specific area you're heavy in South Florida, or is it around here, or is it?
I wish.
Okay.
I wish. There's always cheaper money out there that's chasing deals out here. So we win a lot of silver medals, as we say. It's hard to actually lock in on deals in the Tri-County. Dade County is very difficult because a lot of the capital that flocks to Miami is more preservation of capital. They're almost not even trying to make a return. It's more legacy assets, and they are not needing to that return like we do. So Broward and Palm Beach County are definitely hot zones for us, but it is difficult to find anything that makes economic sense because there's a lot of investors out here that are looking at the momentum. Like South Florida, everybody's still moving here, and all the political turmoil nationwide, more people are flocking here, and all the other benefits that we have in life as a lifestyle in South Florida. But we don't ever buy like that. We're not buying based on momentum. We're only buying based on fundamentals. Where we find the lower hanging fruit is Central Florida, areas where it's a bit more affordable. Because we've become so unaffordable. So you have all these tier 2 and tier 3 markets that are starting to get draft off of the Tri-County. So, Orlando is still somewhat affordable. Tampa has become pretty unaffordable. So we're looking at the outskirts of Tampa because that's what happens. Everybody just kind of branches out to that next radius. Jacksonville is a big market for us because there is a lot of employment drivers there. So I would say Central and North Florida we're focused on. And then, of course, Atlanta. I cut my teeth in Atlanta. So North Georgia, though Atlanta's getting pretty expensive, there are still those much more obvious value add deals there than I'm going to find in my backyard.
Yeah. And I was gonna say you found one in like Asheville too, right?
Yeah, we're in Asheville. What a different market.
Yeah.
We're used to fast velocity here in South Florida. Especially with small bay industrial, you got a lot of South Americans, a lot of tradesmen here. So when one unit became vacant over these last 12 years, there was 5 businesses for every one unit that became vacant. It was such a finite amount of small bay out here and so many tradesmen. That's since softened, but we've been used to that velocity. Yeah. You go in an area like Asheville, though there's not a lot of product, which is what we were really banking on, plus the storms, we figured the tradesmen are going to be busy for many years.
Yes.
It's been much slower than we've been used to. And we found that in certain tertiary markets or tier 2 markets like in Asheville, the tenants have much more control than the building owners. Whereas here, it's just supply and demand. And
it's
just
like they'll sign whatever lease just to get the space.
Yeah.
Right, yeah.
And we've had to acquiesce because we have to still go with the moment. We have to go with the policies, I guess, of that market. We don't want to be the out-of-towners that are saying, no, this is the way it needs to be done. Everybody talks, everybody knows each other. So we've had to be a lot more diplomatic than we normally would as building owners.
That's interesting. I wouldn't expect Asheville to be slow, but I guess compared to South Florida, it makes sense.
Yeah.
I guess population demos, like you got to look at that maybe and see like how many entrepreneurs are really in Asheville that are doing trade stuff versus like how much product you may have on that asset. I don't know how big it is, but I could kind of see it. But what you're saying about the tenants having like a more control, we kind of do see that in some tertiary markets for sure. I was going to say something to that.
No, just for example, we usually, especially with small bay, you don't usually give options.
Yeah.
It's here's the term, here's the expiration, and then we'll talk about renewing at the time at a certain rate. That market, they expect options. It's almost unspoken that there's going to be options. And I'm fine with options as long as that's fair market value.
Yeah.
But a lot of times that's not what they're expecting. And the brokerage community has told us, no, this is the way the market is. You give them fixed rate options. And that's not something we've ever done. And we've had a hard time getting comfortable with that because that really affects the value the future value of the asset. Absolutely. And if you don't know that going in, you're not going to hit your returns. Same thing with Atlanta. Atlanta has a very interesting policy in the brokerage community, which we only found this out maybe 4 or 5 years ago. There's something called pro fees. And pro fees in Atlanta, where if we do a deal in Florida, 6% commission, right, on base rent. On renewals, with co-broker, it's 4%, right? That's pretty standard. Not in Atlanta. Atlanta, because of these pro fees, they wind up getting the first month of rent plus a certain percentage. So it works out to about 8.5% on base rent commission and about 6% on renewals.
Wow.
So that if you extrapolate that over a big asset over many years, the deal we were looking at, we were looking at 600,000 square feet portfolio. It was an extra $1 million just in commissions with that structure compared to the 6 and 4. So you got to know these things, and that's why half the battle is knowing your market.
Yeah. And also why it's so important, you said you were on the phone with brokers all day.
Yeah.
Yeah, and then you want to, and we do that also. Just look, that's the hack. A lot of the brokers that we talk to are not even investment sales reps; they're tenant reps.
Yeah.
The tenant reps know where the tenants want to be. If there's a shopping center with a hole, a 20,000-foot hole, and I know Planet Fitness wants to go in there, we'll talk about the ultimate arbitrage is when you have the tenant in your back pocket. So those are really the hacks in this business to force value very, very quickly.
Yeah. You mentioned several times fundamentals, right? And I feel like a lot of people throw that word around, and we probably know a lot of what it is. But for people listening, like, walk us through what are the fundamentals you're looking at in a deal before you buy it.
Well, it's product type. It varies on product type, but
Let's go with industrial.
Well, industrial. If we're looking at small bay, we want to look at clear heights. Remember, we want units that are conducive to a lot of different businesses, a lot of different type of trades. Mm-hmm. So we need to know that the drive lanes between the buildings are wide enough to get a box truck in there. Ideally, you have a complex that has grade level doors for your pickup trucks, van highs for your vans, and dock highs for your box trucks and trailers. We want to know, the depth of the units, because you don't want a bowling alley. That doesn't lend itself to a lot of different businesses. The depth of the buildings, units that lease up very quickly in virtually every market are anywhere between 1,000 square feet to 2,500 square feet. Those units, you got hobbyists, you got people that just tinker with their cars. You got small businesses, people that just need to put a trailer in there overnight and do some invoicing. So that casts a wide net for tenants. Mm-hmm. Then you have 5,000 and 10,000 foot boxes. Depending on where you are, a lot of those units will sit for months and sometimes, in some cases, years. There's this gap between the really highly desirable units like 2,500 square feet and maybe another highly desirable 50,000 foot box, and everything in the middle sometimes just sits, especially in what we found markets like in Atlanta.
Yeah.
So that's what we look at it for that. And then with retail, it's completely different. Retail, we can tell almost from a desktop if it's a good asset. Especially with AI now, understanding how much traffic certain businesses within the center are getting, by scraping cell phone data to find out how much traffic, that business is getting. The access, the curb appeal of the center. Carolinas, you got a lot of, your topography is very different than South Florida. Here, everything's, just no hills, so it's very easy for visibility. Whereas like Atlanta or Carolina, from a street view, you could tell right away, is it sunk all the way to the bottom? What's the visibility like? So that's more of a paint by numbers asset class for us, which is why we feel very comfortable buying retail in outside markets that we're not really concentrated in.
Mm-hmm. And you're using Placer, I assume, for the data and stuff, right?
Placer AI, and there's a couple other services now that are competing with them. And it's getting much more refined, much more accurate. Everybody's playing catch up right now, including the monsters like CoStar.
That's awesome.
What other AI tools are you using? Curious.
We're trying to find overlays. Here's the problem that I'm seeing. Every small business is spending so much time trying to get comfortable because nobody wants to be left behind with AI. But what's happening is I think productivity is going down. I think people are just trying to fix something that's not broken. So we're trying to figure out where is our real bottlenecks. And our bottlenecks are really on our pipeline, on our deal flow. We have so much stuff coming in; it's very hard to keep it organized. That's a very simple thing that AI is able to control. The other thing that tends to be a little bit archaic that we've been doing for years is going on LoopNet or CoStar and actually just surfing, looking for deals that might fit our criteria. All that can be done now with agents. So those are the things that we're focusing on, not so much these CRM overlays and all these different things that are holding accountability, keeping our staff accountable, this, that, because you can go crazy and spend so much time and so much money with all these companies, and it's all changing. Next month, it's going to be very different. It'll be a different service.
Yeah, that's very true.
God, I feel like that's such a good point because, we cold call a lot, and I feel like half the time it's like, you sit here and look at all these AI tools to try to increase your productivity and stuff, but it takes away from what's actually making the money, like finding deals.
Yeah.
That's such a good point.
Yeah.
Everybody should, we learned actually recently, everybody should have an AI champion in their office. That's the guy who really runs point, determines what makes the most sense to what to implement for you to improve your business systems. So we have ours, and they come from the weirdest positions. We just hired a capital markets guy. We're starting our retail fund, separate and apart from our syndications, but the retail fund is more core assets, more about yield, less about multiple because we're seeing a big demand for that with our investor base. So he's our capital markets guy. He's got a massive Rolodex of capital, and he loves AI and he loves getting smart on it. And he's very quick on the uptake. So he has become the guy.
That's awesome.
Yeah.
Walk us through what you just said a second ago, focusing more on yield versus the multiple. Like, give us a little more color on that.
I think the best place right now to find actual yield or current pay is retail. You could buy in markets maybe that are tier 2, maybe even tertiary, but the fundamentals are there. Your traffic counts and everything we talked about are there. So, and those are 8.5, 9 caps. We have a group of guys that obviously you guys know very well. They just bought at a 10 plus cap for a portfolio of retail. That exists. And now you could borrow at 6.25%, 6.5%, and you have a real spread there. So that's what the fund is really geared toward. And there'll be value add elements and aspects to the property and to the portfolio, to the fund, but it's really all about, how do we maximize cash flow?
How do you, for example, the deal you just mentioned, it's a triple net portfolio of a lot of them, single tenant, triple net properties. How do you avoid buying something that, and I think I know the answer, but how do you avoid buying old Walgreens that goes dark and then, you overpaid for it and then next thing you know it's dark and now you can't lease it for the same price it was leased at and then the value dropped. Because a lot of people buy the single tenant net lease properties, but they're a little bit scary to me.
I like to say we never speculate, but in our business, we're always speculating to a certain degree. We won't move forward on a deal unless we have a strong indication that either we're going to get an extension with the existing tenant, hopefully in due diligence, or we have another tenant ready to go or somebody that's expressed interest. And again, with retail, if you have a vacant building and you didn't pay too much for that cash flow, and Walgreens goes vacant, remember they tend to have they've built on some of the best real estate in their markets.
Yeah.
So if all the fundamentals are there and it happens to be vacant, you might have to invest and prepare to invest into the property. But I'm not too concerned with when it checks all the other boxes. But it is speculative.
Yeah.
To a certain degree, it's speculative. We're looking at a couple Walgreens deals where, I don't want to move forward unless we have a strong indication that, Walgreens is going to extend or we have somebody ready to backfill. And that comes down to not only talking to potential investors all the time, not only looking for deal flow, but also speaking to, your outside influences in this business like the brokers and recognizing, who wants to be there and the platforms and the networking events that we all go to and that we're part of, the mastermind groups. Somebody knows somebody knows somebody. Yeah. And it's just we're all interconnected. And it's like that in any industry, but geez, in commercial real estate, it's super tight, super small. And you're only 2 degrees away from the best friend of the real estate development team of McDonald's, right?
Yeah.
And we see it all the time.
True, for sure.
Yeah. On that note too, one of your first deals, and it was your first retail first retail deal that you did. You subdivided a CVS or Walgreens, made it 3 different tenants, and did really well with that deal
quickly.
So, if you understand what you're kind of getting into, I think, and you kind of build that plan out, you can protect yourself with that as well.
But we always talk about that bulletproof basis, and I paid $500,000 for that CVS.
Wow.
So there was really no further lower we can go on that deal. It was probably never going to be worth less than $500,000. We're in a different time now. So if there's 2 years left on a national credit lease that's already a little shaky, you can't be buying it like it's got 10 years left on the lease, right? You got to buy it, commensurate with the risk associated with that deal. So, and that's hard, especially when you don't have a lot of other deals going on. And it's been frustrating passing on this deal and that deal. Well, this deal cash flows for the next 2 years. So let's have delusions of grandeur that they're going to renew in 10 years, 2 years from now.
Yeah.
You got to flush all that out now.
Yeah. Yeah, that makes sense. What I was going to ask you, are you guys buying anything else right now besides industrial and retail? Or I know some people are dabbling in the office since everything's going crazy, but are you guys doing anything else?
A lot of great opportunities in office.
Yeah.
We're starting to look at it, still a little hesitant, because you're still looking at rental rates. So you buy an asset, and when you look at what TI packages the tenant, the business, and the brokers expect, your rents aren't going up in most office. It's going down when you factor all that cost to get them in there. And then once they get in there, unless it's medical, nobody's really that sticky. It's very difficult to keep a tenant in a building because it's not like a storefront. A picture framer leaves that unit and goes to another location. they may lose half their business. An office is not like that. So the brokers really control that. And, for lack of a better term, you are the office broker's bitch as the landlord. They can take you, they have so much power and so much influence in this environment where there's so much vacancy. It's still a little shaky. It's gotta be a steal, and it's gotta be in a central business district. It's gotta be in an area that's got a lot of amenities like restaurants, close by gyms or, interstate. So there's got to be a lot of things going for the office for us to start getting interested. But listen, I think fortunes are going to be made in the office sector. I think we've seen pretty much the worst.
Okay.
Again, AI has created all this other now, like, well, we need office for it all.
Yeah.
But at the end of the day, we are social creatures. I think people are wanting to get out more now than ever before because we are behind the screen so much.
For sure.
And don't even get me started on the GLPs. I think people are just feeling better about themselves and they want to get social. And I think restaurants, bars people are drinking less, but they're hanging out more.
Yeah.
So I think retail is it's pretty, brick and mortar is certainly here to stay. I'm not a big fan of big box because I really don't know what the future holds there. But neighborhood shops, gyms, restaurants, bars, buffets, hair salons. I love the experiential-based shopping center.
Yeah. No, that's such a great point about the storefront that you mentioned a minute ago. I had never thought of that. I always take away lots of information, but that's a golden nugget. Like, if a business moves and someone's used to coming to that business for a long time, it kills them.
For sure.
I never thought about that.
They'll sooner be late on their mortgage, on their residential mortgage than paying you late on rent, unless they're just going out of business anyways.
Yeah.
It's been our best asset class. When I look at the properties that we had, industrial has been very good to us, but our best asset so far is a retail shopping center we've held on to since 2014.
That's incredible.
That's the one in Atlanta. I think you did a video on that one somewhat recently.
Amazing asset. And you'd walk by, you're like, okay, why is this so great? I mean, we're drafting off of a Walmart that does 125 million a year. It's the top 5 Walmart in Georgia. Wow. So once you get off the interstate, you have to pass our center. So those are the fundamentals that I talk about. That's what you want. Like you want to be drafting off the monster and have more. We have the center is very much has a lot of destination location type tenants like Kids Bounce House. Monster Mini Golf is in there. A Chinese buffet that's right off of 2 of the major interstates in Atlanta. So it's great. It's pulling not from the 1 mile radius, which is usually where we look for shopping centers and the density within 1 mile. Yeah. This one's pulling from like a 10-mile radius. Also, Phantom Fireworks. It's again tenants that you're like, all right, not crazy about them, but they all work off of each other. They all draft off of each other. It's great synergy, and it's the same tenants that have been there since 2014.
Yeah. We recently talked to somebody else that had mentioned that like shadow Walmart centers and stuff like that, they do very well and people focus on that, but they're drafting off that Walmart. That's incredible.
Yeah, we've done everything we've done so far has been industrial, but I would love to buy a retail property. I would love to.
And for you guys, I talked about this before, the size deals that you buy, back of the napkin underwriting, something very easy to really get your arms around, a small 10,000-foot retail shopping center, 4 units. 5 units. Very easy to underwrite. If they're clean units, they're just, front to back. It's just the configuration isn't all cockeyed where units are wrapping around other units. And it's nice and clean and you got maybe 1 vacancy. That is so easy to solve for if it's got all the fundamentals. So that's what, if I were you and if I was starting over again, I would never have done a 156 unit apartment complex in the hood. I would have done a 10,000-foot retail center and built off of that.
Okay. That's awesome. We're, I guess, technically buying a retail deal right now. It's like more of an industrial, but CoStar's got it as retail. It's like a 3-unit automotive building.
Great.
The cinder block, it's in Durham. It's about 3,900 square feet. So it's small, 3 tenants, but we're buying it for $575, which is, decent. And we got the right to negotiate leases. So we've already released to, Charles helped us a lot with this stuff. He found the deal. And then one of them didn't want to renew, so we're trying to release it. But our thought is, buying it for $575. Once we get the NOI to where we think it's going to be, it's probably around $70,000. We'll put it on the market at 8.5 cap, which like a lot of people are buying 8.5 cap. Maybe 8.5, 9. But at an 8.5 cap, it's like 8.25. So it's like a decent little spread.
Yeah. And
that would be like our first attempt at a flip. That's kind of what we're trying to do right now.
So I mean, the question is, again, the rule of stockpiling your own money. An 8.5 cap. I mean, are you buying it at an 8.5 cap?
We're buying it.
No, I'm saying, would you buy that deal at an 8.5 cap if you saw it widely marketed?
Probably not, no.
Okay. Then that's your answer.
Yeah.
In our market, I see that even though it's only 4,000 feet, 8.5 cap, like, all right, maybe I'll just buy this for myself. Like, it's That's an interesting deal.
I mean,
and Durham's a great market.
It is a great market. It's like a little bit of a weird location. It's like off the highway, but you can't get to it, and there's residential around it. And it's like a little ghetto, but not really.
Mm-hmm.
It's like in an area that's growing, but a little ghetto. And the main reason is just to get a little liquidity.
Right.
Otherwise, I probably would keep it.
No, but and you're doing it right. Just as you do that, try to find one a little bigger.
Yeah.
Same fundamentals, but something larger. Right.
Yeah.
That's how you're going to scale, not just buying the same. And that's the problem in the residential space. You're constantly buying the same thing over and over again, essentially, and flipping it. Or if you're a wholesaler, you're doing the same thing over and over again. You're never really scaling a business.
Yeah.
It's just more volume, but it's still sporadic. Chunks of money. So that's how we did it. We just one deal at a time, and we would buy a 10,000 foot deal, but we wouldn't hold a 10,000 foot deal. We're going to sell it. We'd sell it off.
Yeah. What's your thoughts on like doing two at a time? Do you ever do that, or do you try to just do one deal at a time? Like buying two at the same time.
Well, if the opportunities are there, sure.
Just got to be like extra diligent.
Look, you can't steal in slow motion. So if the deals come up, it doesn't matter if they're staggered. Right? I just take advantage of whatever opportunity comes at you
As they come.
Yeah.
What he was getting to is we've done two at a time a few times, and when I've done three, we've kind of dropped the ball a little bit on one of them. I do agree with Graham, but I also feel like that specific asset was just a touch ghetto. It's like literally just on the wrong side of the railroad track. I feel like buying what we're buying now in Durham, as our third deal, we wouldn't have that issue because of the location, because of honestly the zip code that it's in. I mean,
We're trying to be a little pickier.
Right,
we don't want to be too picky, but everything we bought so far has been in a market that's good. It's got a good university, and it's just, I don't know. We'd rather buy better locations, because something we've learned for sure, and I know you know this obviously, but people listening, like if you buy a property that's $40 a foot, but it's in a worse location, you're better off paying $60 in a better location, because everything will be easier. You'll get a better tenant. You'll lease it faster. You can flip it faster. All the above. And we're kind of learning. We've learned that now after 9 buildings. It's like,
and it's like that with every product type virtually, especially multifamily. People got enamored with the price per door. I mean, I got enamored with $10,000 a door. Like I paid $9,700 a door for the apartments. It's like, oh, well, how can I go wrong on $9,700 a door? If I wasn't in 2010 or late 2010, early 2011, I don't know if I would have got out of that deal the same way. It was a very challenging deal, and I just caught the momentum of the market, which is why I say it wasn't the right first deal for me. But I had the market momentum, the wind in my back. People constantly get enamored with that. Wow, it's only, even industrial. Well, it's only $40, $30 a foot, but it's archaic. It's obsolete. That's not. Your truck courts are narrow. Your clear height sucks. Your column spacings are bad. I see this all the time. And where's the demand, right? You see all these $20, $30 foot deals in rural markets. Those buildings are left for dead for a reason.
100%. Yeah. Where I'm curious, where is most of your deal flow coming from? I know you said you talk to brokers a lot, but do you have people cold calling for you off market, or is most of it from brokerage or people bringing you deals at this point?
I'd say 20% of the deals are direct to owner. Okay. We either have calls, letters. We still do it old school, and 70% of the deals are, I wouldn't say it's that high. I would say at least 30 to 40% of the deals are coming from the brokerage community, but they're not widely marketed deals.
They're like off-market pocket stuff.
Right. And we all do it. As owners, we're saying, all right, you know what? Bring it to one group or two groups that you trust, that they can close, no retrading, and maybe we'll do it quietly, right? But I don't think anybody really knows where the value is right now. So unless you get some stupid offer from somebody who just doesn't really know, then I think the best approach is to widely market it. So in short, 60% of our deals still come from widely marketed deals, call for offers. But look, some of my best deals have come from that. That shopping center in Atlanta, I talked about it in the video. That was a widely marketed deal that just fell out of contract. So that's a big one. It's widely marketed, fell out of contract. Here's your opportunity to swoop in.
And did you have an offer on it at first?
We had an offer. Well, we were in the mix. We got passed up for a higher offer. It fell out. They went under contract. They were dicking around, and then I bumped into the broker at ICSC back in 2014. He said, "Hey, remember that deal that you offered on? It's back on." I'm like, "I want it. Just let me know what I need to put out."
Yeah.
So that's how we did it.
That's a huge lesson. Yeah.
I always tell, like, we do brokerage still, so like I'll send people deals and I'll be like, "This is what the seller's asking. It's too much. I know that already. I'm telling you right now. But if you like the deal, then offer where it makes sense for you, because I don't think it's going to sell at this price. And then the people who bring LOIs or an actual offer or whatever, the seller's like, no, I'm not interested.
Right.
But then 6 months later, who are they going to call? They're going to call the people who actually brought an offer.
That's right.
And I try to tell people that. It's like, I feel like that's such a key thing.
It's all about starting. It's all about having a dialogue. Just start a dialogue. Just talk to them. Our policy in the office, which we have to raise our own game. We're at 3 offers a week now. That is the policy.
That's
3
amazing.
offers have to go out a week. The package, proof of funds, bio, deal sheet, and our LOI, just to at least to have it in the tickler if they just not interested in the offer, not interested in countering. But they saw that we were for real. We actually put some thought into it and gave them a whole clean package. We do 3 of those every single week. So, that's a lot of deals every year, a lot of offers every year to arrive at hopefully 3 to 5 deals a year to close on.
Yeah. But I think that speaks to you guys sticking to the fundamentals, because if you're saying, okay, well, this is where we would be on this deal based on the price per square foot, based on what we think we can rent it for, based on current vacancy, then you just make the offer there. And if it doesn't work, it just doesn't work. It's not the end of the world. We're not in this game we don't get paid on the LOI, we get paid on the transaction, but you just don't want to put yourself in a bad position.
No, I agree. I mean,
That's good.
there's a lot of time. There's a lot of deals that will come back 3 months, 6 months, a year from now. We had one guy call 6 years later. 6 years later, he called from a letter that we sent them. I know this because it was an employee in the office that hasn't been with us for 6 months and 6 years, and it was his name on it because my name. I didn't want them to think that I was a commercial big, buying a lot of properties. I was focused just on that property, so I used somebody who wasn't well known in my office. 6 years later, he's like, "Hey, you sent me a letter a while back. I'm interested in selling now. Like, can you show me the letter?" And sure enough, it was
That's awesome.
somebody from 6 years ago. Yeah.
That's incredible.
Well, that's a interesting thing on the letter thing I've never heard of before. Positioning yourself as like it's your group, yes, but it's not your name on it. I think that's interesting.
Well, when we get those letters, I'll immediately look up. If we get a letter that actually is specific and it's well drafted, where I could tell that they actually know the property,
right,
I'll immediately look the person up and get a sense. Okay, did they do this, massive scale, or are they just a local owner?
Yeah, that's so cool.
Yeah.
Letters are great. We've used letters a couple times. And,
yeah.
I don't know if we've gotten any deals off them yet.
Brokerage,
We've gotten
yes,
deals.
but not for ourselves.
It's tough here.
Yeah.
It's tough here because they're getting inundated with brokers. Hey, got a 1031 buyer that's looking in the middle of an exchange.
For sure.
Located your type of property.
Yeah,
You
we
never
use
know
the
if
same
that's
thing.
real.
Yeah, we do
Right.
the
You
same
never
thing.
Right. I know. We know the game.
Yeah, for sure. Well, I guess outside of the stuff, we were just talking. You just got back from a sick trip. What else do you like to do, like besides real estate? You're traveling, and I know you just built a beautiful house too.
Yeah. I just love being on the water. That's why I could never leave South Florida. We're having that conversation. You guys are in a great market too, but this area is very special. It's funny. There was a meme that was going around years ago when LeBron left the Heat and he went back to the Cavs, right? I think that's what happened.
Yeah.
And they showed a video of Cleveland going absolutely insane, jumping all over the streets, just celebrating. And then they put the video on Miami. Everybody's going crazy. It's insane because there's so much to do. There's such a lifestyle here in South Florida that it didn't matter.
Yeah.
It's the downside of that is you just don't have a great loyal fan base in sports.
Yeah.
But this is just an amazing,
But still,
amazing place to live.
I see what you're saying. Like, it's so much. You'd rather have all these different options than live. Like, no hate on Cleveland, but you're saying Cleveland, like their main thing is sports. Here, it's like you get to go on the water, you get the boats, the weather's beautiful. Yeah, it's sick.
Yeah, I mean,
that's awesome.
golf, water, outdoor activities, other than the summertime. I mean, that's what I love to do. Obviously, hit the gym.
I'm the same way. I love the water, love the ocean. We've been to Hawaii a couple times because of that. I've come down here a couple times. If it was up to me, we'd probably live somewhere at the beach. My wife likes the mountains more, but we're right in between them, so it's a good sweet spot. We can drive to the mountains, we can drive to the beach.
Like as I get older, I'm loving the mountains more and more. I'll be in Colorado for most of the month.
That's
Most of the month of July. Yeah,
That's awesome.
Yeah. I'm definitely more, I think I told him earlier, I'm more of a beach person, but I definitely lean mountains. My family's from the mountains, so it's kind of like a home a little bit for me. And I don't know, the mountains just kind of have a thing. We went to college in the mountains in Boone, North Carolina.
Okay.
And it just kind of feels like home for me, for sure.
For sure.
yeah, I love it. I'll be in Asheville in a couple weeks.
Awesome.
Oh, cool.
if you get a chance, Boone is very small compared to Asheville. It's not a city. It's like a college town.
Yeah, for sure.
So there's a lot of cool outdoor stuff, but other than that, there's not much. But we liked it. But yeah, I mean, this has been incredible. I know he said our time's close to up here. So if people want to connect with you, find more out about what you're doing, get your book, what's the best place to do it?
Yeah, I mean, if you go on Amazon, Built from Nothing, I'm on Audible. You get my rugged tones in the middle of the night. I'm narrating it, so it's on Audible. And then look, we're like you. I know you guys are in a crossroads right now, looking to maybe start bringing in investors. We're always raising for our next deal. And the reality is, we never know where the next equity check is coming from. But we have, 180 active investors, 500 on our distribution list. If anybody wants to be on the distribution list, they can go on genevagp.com or just shoot me an email. We could probably put this on the
we'll put in the show notes for sure.
On the link there. But yeah, I mean, everything is there. The book is about real estate war stories, the things that I went through, the things that I learned, and just the challenges of a kid from the street, and just I dropped out of high school. I did not go to college, so a lot of people just have these limited beliefs, and hopefully this book has a little bit of inspiration to it that kicks somebody in the ass and says, don't use anything as a crutch.
100%.
For sure. That's incredible. Well, you guys heard it. Go check them out. And we really appreciate you listening. And we'll see you in the next one.
Thank you for your time.
Absolutely. Thanks, guys. Appreciate it.
Thank you.